Hey traders, welcome back. So we're talking about position sizing, and this is a really interesting topic because in my opinion this will make or break your career as a trader. Get it wrong, and if you get it wrong on the upside and let's say you got in too aggressively, you're going to wipe out. It's simple as that. You know, the law of probabilities mean you will wipe out if your position sizing is too much based on the strategy you're using, and vice versa. If your position size is too small, there's no point. You know, you're trading and you're making a few quid here and there, you're putting all the effort in, and unless you're trying to scale it up at some point, it becomes pointless, right? You're putting all that effort. At the end of the day, guys, you and I are both here to make as much money as possible for as little risk as possible. And it's finding that sweet spot in trading that's so crucial. You know, we want to make as much money as we can. We don't want to risk so much that it's jeopardizing our bank balance. And of course, you know, that's a fine line. Like I say, too much, you wipe out. Too little, what's the point in doing it? Okay, so fixed ratio position sizing. This is a strategy where you say to yourself, hey, you know what? Let's just use some numbers for argument's sake. It could be anything. Let's say, okay, we've got £5,000 in our spread betting account, in our CFD account, whatever it may be. We are going to use a specific position size while we have that £5,000. And let's say, for argument's sake, I've not done the calculations on this, so you know, you can pull me up on this if you think that this is not the right thing. But let's say you're doing £10 a point. Now, obviously, that's going to depend on what instrument you're trading. If you're trading Apple at £10 a point or Tesla, then that's going to be a little bit hefty. If you're trading like FTSE or something like that, then it's going to be a little bit calmer, isn't it? So, you know, we get the idea of that. But the point is then you say, okay, I've got £10 a point, that's my risk in trading. It's going to be multiplied by, you know, whatever my maximum loss is on the trade, you know, in terms of ticks, in terms of percentage move or whatever. So that's going to be a position size, and you're saying to yourself, listen, I always trade with 25 tick risk if I'm day trading, or I'm trading with 100 and something tick risk, or whatever it may be. You know, obviously you might adjust that £10 a point with 100 and something risk is maybe a bit too much, your 5,000, but you get the idea. Okay, now what you say to yourself is, right, I will stay at that position size until I make another 5,000. Okay, so if I make another 5,000 in the account, then I'm going to double up my position size to £20 a point. Now, this is known as the delta. So in other words, you're using this as a benchmark to increase your position size. Now, obviously, that's quite a big jump, going from 5,000 to 5,000 to £10,000 and doubling your position size. And there's if I can get my words out, there's a psychological element to that we won't discuss in this video, but I definitely will in future videos because it's so important. It's not just a case of mathematically increasing your position size. We all get to a point where we say, hey, this is quite a lot of risk here, and we start to trade differently. But we'll discuss that in a future video. So make sure you're subscribed if you want to catch that one. So £10 a point, then you go up and you say, okay, now I'm going to trade to another £10 a point, which is obviously going to be £20 a point. And that's how you tend to do it. Now, of course, you can dial that down into different increments. You can say, hey, well, for every 1,000, I'm going to trade £2 a point. So obviously if you've got 5,000 in there, you're trading £10 a point, you make another 1,000, you go to £12 a point, you go to £14 a point. You're basically using that ratio of increase depending on your initial capital. Now, the point is with this is that if you start off with a big amount in your trading account, let's say you have another zero and then you've got 50k in your trading account, you still only use the same amount as you start with, but then this is where the floor comes into place, because you may well be using £10 a point, and in fact you could do more, but you're stuck at the 50,000 because those are the rules. The rules are you start off with the set amount and then you have to increase by another 50,000, another 50,000, another 5,000, another 5,000. So, you know, this is okay. I can see the advantage of this. I'm sure you can see the advantage of this. It kind of makes incrementally improves your position size as your account balance grows. So if you're getting up and you're doing well, you're kind of growing with it so that your percentage return is going to be representative of your performance. There's no point in sticking at £10 a point if you've suddenly got £500,000 in your account and you're doing £10 a point when you're at 5,000. You're not going to get the same percentage returns as you were getting before. Now, granted, that may well be a bit aggressive at the beginning. You may say that's a little bit aggressive, I need to dial it down. And traditionally speaking, you know, there are a lot more fixed rules with this fixed ratio position sizing. I've adapted these slightly, and you can do whatever you like with it. You can use it as a guideline and say, hey, well, you know, for the delta of 5,000 or 1,000, I'm going to do this, but I'm going to add a little flavor, a little twist into it. I'm going to, you know, maybe add a little bit more, or I'm going to not add so much because of this, because of that. That's what trading's about, guys. You don't have to stick to it. As long as you stick to what you've planned out and don't change it on the fly, that's when this becomes completely useless. If you're changing your position sizing on the fly, 1 minute you're doing 10, 1 minute you're doing 50, 1 minute you're doing 1 minute you're doing 2, and there's no structure to it, there's all very well doing variable position sizing, and we'll talk about that at some point in the future as well. But as long as you have a structure to it and a plan and a strategy, then you know you can use something like this as a benchmark and adapt it to suit. So anyway, guys, if you like this video, give it a thumbs up. Don't forget to subscribe for more videos from me and other traders on this channel. Any comments about that, leave them below. I'll read them, and I'll see you on the next one. Take care.